say goodbye to these annual rates of return of 16 to 20% coming out of this decade-long bull run that we've experienced in the stock market, because that is what this article is claiming, saying the VOO S&P 500 annual returns will likely only do 2 to 5% for the next decade. Now, we're going to take the two-headed sword conversation of this by listening to the bipolar opposite being Cathie Wood. They came out with a fascinating little talk last month that I'm going to share with you, but I want to break down this article and kind of what they're defining here, because according to the summary, they're claiming U.S. equities just ended a 10-year period where the rate of share price appreciation has been nearly double that of earnings growth and 40% higher than the dividend growth. They're claiming two modified versions of the Bogle model, which, if you aren't aware, rest your soul in peace, the great late Jack Bogle, the creator of the VOO and likely responsible for making more people rich in the US than any other investor alive. They're claiming, based on his modeling with moderate assumptions, put future expected returns of the VOO in the low single digits with more aggressive assumptions required for higher rates of return. And they get into a lot of mumbo jumbo in here, but a lot of this comes down to one defining factor, which is put into this chart, which is stocks should not outpace dividend growth and they should not be outpacing the PE ratio. And they're claiming that stocks have disconnected from those fundamentals. Now, if you're new to investing, can I please simplify this for you? Do you know what a PE ratio? It's called price to earnings. How much money does that company earn versus the price you're paying for the stock? Now let's use Microsoft, trading at a 30 PE. Means if you bought it today and they weren't able to grow earnings and everything flatlined, it would take you 30 years to get your money out of Microsoft. But that's not the case. They are growing revenues rapidly, bringing that PE down pretty aggressively. And if we're talking about the VOO here, which people were getting petrified because at its peak was trading at a PE of 35, and this is a list of 500 companies, but lately earnings have been outpacing the PE ratio. And now we see the S&P 500's PE down below 30 in the 28 range. This is actually a bullish signal, in my opinion, coming from this article, which doesn't seem to reflect that in any real way. But when we scroll down, one of the funniest things I think is hilarious is the comment sections themselves, because people make a lot of good points down here. Like, I am straining to decipher the logic of this article as much as we'd like to believe in it or feel comfort by it. The historical data is not predictive. There's a lot of other funny comments. I wonder how the future returns would look if you removed half of the top 20 holdings in the VOO. Food for thought. Also very entertaining, because those top 10 holdings make up almost 30% of the entire S&P, and those are all fast-growing tech stocks, right? Now, I admire the work you've done. The analysis appears to be thorough, and it looks to my untrained eye like you have a technicals buttoned up tight. And the problem I see is that whenever someone tries to act like they see the future, I just yawn. All of this comes into tandem into one fact. Do you believe earnings will continue to grow, or do you think they're going to stagnate because of the logistics, chip shortages, lack of money printing, and all these other factors coming into play with the interest rates rising? I mean, those are a lot of things to be concerned by, but I want to simplify this way down as Cathie Wood does, making some pretty incredible points. Take a listen.
I'm going to give a shout out to Tom Lee from Fundstrat. He picked up on a study that Stan Salviksen, who was the chief strategist of Merrill Lynch in the 80s, when I was just coming of age in this market. Stan had a hypothesis that the baby boomers would make for 15 to 20 years of a bull market in equities. And that's what happened. It was a very simple assumption, and it played out beautifully. Tom Lee, I don't even think he referenced that study, but has taken the notion that millennials are the reason we're in a bull market for equities, and that this leg of the bull market won't end until 2026. And I think he thinks that the bull market, with some fits and starts after that, could actually extend to 2038, I believe it is, which is the year that the number of millennials peak.
Now that was a pretty simplified discussion. I mean, she's basically just saying because of millennials, the market could continue to go up from anywhere from 5 to the next 15 years. She wasn't really getting into the core factor of what she usually spouts, which is innovation. The fact that innovation is transforming every sector across the market, from financials, fintech space, whether we're talking utilities, whether we're talking auto sector with things like Tesla. Those companies, I think, are what are going to be driving the future growth of the market, still sustaining over 10% returns. That is my personal opinion. Now, we might get a few years with some hiccups, but presuming this technological shift happens, we keep seeing these top 10 companies grow at really healthy rates. I mean, I don't see why we can't get average returns or better than average expected returns. Now, this is definitely a double-edged conversation, and I want to pass the question off to you guys. I mean, we are trying to predict the future, which is damn near impossible, but hey, let me know how you think these predictions are going to turn out in that comment section below. Stay cool. stay awesome, and I look forward to catching you tomorrow.